So Crocs recently released their annual earnings and they provided guidance for 2024, and it looks like the market is excited about this name, at least in the business news media, and this is what I'm talking about. So there's a glowing article on Barron's that effectively is saying that Crocs stock is jumping, however, there is room for another leg up. And effectively what's happening is that, people are seeing strong guidance and strong guidance being maintained. However, there is something that I think some people are missing based on what the company has guided towards, and I'm going to point it out in this video. And I do have to say that over the last year, the stock is actually down 10% or approximately 10%. So just be aware of that. However, this is all relative because if you look at the name over the last 5 years, you can see that the name has been up significantly post-pandemic. And of course, we started picking up on it a couple of years ago after it just cratered down in mid 2022. And so full disclosure, I have been in this name for a couple of years now. I've sort of like buying and selling it type of thing. But it's kind of getting to a place where I might just hold on to the shares that I have and I might potentially add more. We'll see. And so the article goes on to say that the analysts were very happy. And so one analyst said that it was a very solid finish to a strong year. And this particular analyst, Jonathan Comp, raised his price target to $160 per share and reflected his ongoing confidence in the stock. He rates it an outperform in the industry. Rick Patel boosted his target to $145 from $120 following the results. So both of them have very compelling upsides to their price targets. And remember, these are 1 year out price targets that the analyst community provides, whereas I provide intrinsic values, or at least I use intrinsic values for myself when it comes to investing. I don't recommend that you guys look at my modeling or my valuations and you use that to make your own investment decisions. I highly encourage you guys to build out your own models and determine if these things are right for you. And here's where I might disagree with the article a little bit. Now, Crocs 2024 outlook still leaves some room for upside surprises while the company is steadily paying down debt and actively repurchasing its own shares. However, I would say that their 2024 outlook, yes, they're only guiding to 3 to 5% revenue growth. So I see where there's some upside surprises, but there could potentially be some downside surprises as well, especially when it comes to potentially deteriorating margins. And they even actually told us that. And so you have to be aware of that when you build out your model on this particular name. And I'll walk you guys through that in this video. So first, just starting with their guidance, you can see that for the full year of 2024, they expect around 4% of revenue growth. Notice that Q1 is not anywhere near that. So just first thing just to be aware of. Second thing is they expect earnings to be around $12.25 per share. Okay, fine. But the thing that you really should be paying attention to is where do they expect their adjusted operating margin. So notice that the way that they get their adjusted EPS up to their guidance is partially with higher operating margins than they expect to achieve in Q1 of 2024. So this is a bit of a risk. And so if you're modeling this thing out, maybe consider bringing your adjusted operating margin down lower than what the company is guiding towards in 2024 to be a little bit more conservative. I haven't done that, but in the 5-year valuation, I've brought the margin down considerably. And so here's what the analyst community thinks about the name. They think that the company's going to make right around what they're guiding to. I'd probably bring this down a little bit, but they're forecasting around $12.42 per share, which reflects a $9.6 forward PE. So essentially what the market is saying is that there's a lot of risk in this name and they're not willing to pay a premium, like a 15 times earnings for this thing. And so that is very interesting. So there could be some potential upside here if the company continues to execute. And so what are some of those near-term catalysts that could lead to some of that upside? Well, they expect continued global growth led by international markets, especially the Asia-Pacific region, which is fine. But I think more people are looking at these next two bullet points that I have, because recall, a lot of the like they're only guiding to 3 to 5% of revenue growth. So I don't think that you're going to get a huge upside from here. I mean, you could a little bit, but I don't think it's going to be there. I think here's where you're going to get it from. And so effectively what they're doing is they're guiding to people's reservations with that Hey Dude acquisition, because thus far it hasn't panned out the way that they've wanted it to. At least it doesn't seem like it has. So they want to stabilize the Hey Dude gross margin, and they expect more full price selling. Recall that there was a lot of discounting on Hey Dude last year, which is what caused the market to get a little bit weary on this. And so they're also saying that they're expanding Hey Dude's channel diversification strategy, which is something they spoke about last year when the market got a little bit weary on it. And so the execution of these two bullet points are going to go a long way. Now, when they say they're prioritizing both debt pay down and returning cash to shareholders through buybacks, I really think that they're probably not going to be paying down a material amount of debt this year, and I'll show you why later in the presentation, or later in the video. But I do think that there could be some material share buybacks this year, which really boost and get them to their EPS estimate, which is what they're trying to get to. And then just from a longer term perspective, notice that they do remain confident that it's going to be a $5 billion revenue brand over the long term. But notice that I stated 2 years ago that I didn't see them hitting that $5 billion in revenue by 2026, which is what they got it to. I believe I might have been mistaken on that. And it looks like they pulled back from that guidance, but I do see them getting to $5 billion near the end of the next 5 years. So they're going to get there. But I just thought that it would take longer than what they were originally forecasting for. Now, here's the thing that you guys have to really be aware of. And I put a red warning on this. They're trying to maintain industry leading margins over the long term. However, they gotta recognize that the margins that they've been seeing lately will not remain at 26% each and every year. And so you guys have been warned. This is a small point, but they put it in their deck for a reason. So adjust your models accordingly. And this is what I'm talking about. You can see that their operating profit margin was 26.4 on an unadjusted basis in 2023. Now, I'm keeping them at around 26% in 2024. I do think that they get there, and I might be wrong. I might be too bullish in my valuation model here on the margins, right? I'm definitely at the midpoint in the revenue part, but yeah, I might be a little bit too aggressive here. So take that with a grain of salt, and that's why you shouldn't rely on any of the models that I put out. And there's always the disclosures there, but notice what I'm doing for 2025 and thereafter. I'm bringing the margins down considerably, and technically we could be bringing these down even more, but I think 23% is a good place to be based on what we know about the company thus far. But my valuation reflects margin compression. Now, when it comes to inventory risks, I don't think that there are any material risks here. I think the industry-wide supply chain issues are due to lockdowns are now largely behind us, and I think that they're managing inventory well. And when it comes to their capital allocation, I think here's where there's some news for investors, because notice where they've gotten to in Q4. Their net leverage ratio is now at 1.3x, and so their net leverage target is in between 1 to 1.5 times, and so I suspect that there could be a substantial share buyback in 2024 depending on how much cash they generate, as they now have reached their leverage target and they have $875 million of authorization remaining, which reflects approximately 12% of the current market cap. And so if you believe that the shares are underpriced or undervalued somewhat, which I do believe that they are, now's the right time to make some accretive share repurchases. And notice that they were very quick to repay the debt, and they repaid $666 million in 2023. So where does that take my valuation? Well, just giving them a terminal multiple of 15 times earnings. Now, you guys might disagree with this, so use whatever terminal multiple you guys are comfortable with. And that gets me to a valuation of around $169 per share. So I'm kind of in line with some of the more bullish analysts on this one. And effectively, the company is trading at around 70% of its intrinsic value, so not super cheap. I don't think I have enough of a margin of safety here. I think I might, if I were to purchase this, I'll probably use some options to bring my net purchase down substantially, or not substantially, but significantly lower than this 169. But, based on the current share price and based on where I expect earnings to be at the end of 2024, the company's trading at 9.8 times earnings, which reflects a 10.2% equity yield. So I want to know what you guys are thinking. I know some Patreons do own Crocs. I want to know from you guys if you guys are still interested in this name, or are you going to use this run up over the last little bit to take some profits? Let me know what you guys think. And I'm really interested to know if somebody's interested in entering into this position at the current share price. Now, if you're not interested in Crocs, one of the things that I do provide to everyone is all of my research, which you can get access to at the lower tier of the Patreon. And so you can see here's where Crocs is. I believe they're valued at around 100, or I believe that the intrinsic value is at $169 per share relative to the current share price of around $119 per share. It's around 70% of its intrinsic value. Here's the forward PE and the equity yield. And so this sheet makes it very easy to compare all the names just on one sheet. And then, of course, you can click in here and get to the model, which I just recently showed you as well. And so behind this blue, there's a whole slew of other names, and I'm constantly updating this. And so if you're interested in accessing all of my research, you can access all of my models at this lower tier of $5 a month. And if you want to join us for an epic live presentation, you can join us at this higher tier. And like I always say, if you join the Patreon and you find that there's no value to you, just let me know within the first month, and I'll completely refund your first month subscription, because I don't want to take any money from anyone who doesn't grab any value from this. And so I'll leave it there for you guys. But once again, let me know if you guys are interested in this particular name or any other companies in the retail space. What am I missing here? Are there names that I should be potentially adding to my tracker? And so let me know in the comments below, and I'll see you guys later.